Position size or trade size is more important than your entry and exit strategy when trading. You can have the best forex strategy in the world, but if your trade size is too big or small, you will either take on too much or little risks from the market. Percentage of capital or percentage per day. Now, there's different ways to trade. You can trade if you're starting out with a small account. Sometimes you want to trade percentage of capital per day, not just per trade, because your account is so small that you can take so much trades in a day. But if you have an adequate account with enough money, you can trade 2, 3, 4, 5 trades a day. It all depends on how much you have in your account. So talking about this, I will go straight to show you how it works. As an example, if your risk is 1%, risk is equal to 1% amount of 5,000, you will have $50, right? Your stop loss pips, it all depends on your strategy. You might be using maybe tight stop loss, or maybe you're in a swing trade, or maybe you're scalping. It all depends on your trading plan, your trading strategy. But normally it's always good to have more than enough stop loss, so that even when the market is correcting, is pulling back, the market is retracing, the market is going to have enough space to pull back and still return back to the main trend. That is why I will suggest that when you are trading, make sure that always you have more than enough stop loss. Now, position size and formula. This is the formula here. Now, when we apply this formula to this $5,000 account, you will see that risk per trade divided by stop loss pips is equal to 0.2. And when we divide the 0.2 divided by 10, it's going to give us our lot size. If we have that lot size divided by 10, we're going to have our original lot size. Why do we divide by 10? Because we are trading in a standard form. And if you check it here, your 1% risk, here we're using 250 pips stop loss. When we say 1% risk is equal to 250 pips stop loss multiplied by 0.2, which is equally 20 cents approximately, we have is equal to $50, which is our risk of 1% from this account, $5,000 account. You can also use other methods or an online position sizing calculator to do this. So it's not something really difficult. Your trading platform has everything for you. If you can look at this here, you just go there and select your lot size. Then it all depends if you are buying or selling, then you place your trade. Going back to this same point, control your risks when trading to minimize drawdown. The problem traders are facing is because they don't know how to control their risks. If you know how to control your risks in trading to minimize your drawdown, you will always be in profit. Because when your risk is controlled, you will see that your profit is going to be more than your risk. Here we say 1% stop loss rule, $50, or 1% risk portfolio rule. Looking at this two, the first one here is 1% stop loss rule or 1% risk portfolio rule. Now let me explain. The first one is the kind of trader that wants to risk everything in just one trade. And here we have another trader who split his risks. This is the same $50, split it into two places here. $25 and $25 will give you the same $50. Now, if you risk this $50 in one trade, and that trade goes against you, and you lose this $50, you're out of the market, you've lost 1%. But if you split your risks into two places, you have $25 in one trade and you have $25 in another trade. Now, this is going to give you an opportunity to either win the two trade, win one, or lose one. Now, with this kind of concept of risk portfolio rules, splitting your risks, in other words, people say, don't put your eggs in one basket. If you split your risks, then you will see that you will be in a better position to be in profit, because you will have the opportunity to break even or even make more profit. So when you control your risks in trading, you will always minimize your drawdown and maximize your profit.